Hello, hello, everyone. I'm excited for part two of a three-part series in collaboration with Live Oak Bank. This conversation is streamlining acquisitions, essential documents, and timelines explained. I'm really excited to have Kalen Weaver from the inclusive banking team at Live Oak Bank with us. We In our last conversation, we had Mike. Mike is under the weather, but he brought in Kalen, who is on the ground on the street, so he's more than equipped to give us the nitty gritty. We also have Lillian in the background as well, so the whole team has come out to support, and we're excited. So Kay, let's talk a little bit about you. Let's start off with, what is your role at Live Oak Bank? What got you excited about, kind of, spending your working hours in this space? Who are you?
Yeah, excited to be here. Like you mentioned, Brandon, excited to be a part of this team in particular. The work that we're doing day in and day out. So my career actually started. I graduated from college and started in wealth management. So I was working with financial advisors and working with some folks with wealth management on the personal side, and really dug my heels in there and felt curious about building wealth. What does that look like? And it's not just through the stock market, right? But um, so then transitioned back to Wilmington, which is where I went to college, to take a position at Live Oak Bank within our servicing department, and did that in 2019. And have since had some different roles at the bank. I've been in our underwriting department. I've been a loan analyst, working to work like really closely with senior lenders in our credit department. So I've had a wide variety of experience and exposure to the loan process for business owners and building those strong foundations on the key benefits that Live Oak has to offer business owners as they're pursuing acquisitions and borrowing and so on and so forth. So
Excellent, excellent. So just to kind of ground the audience, again, this is part two of a three-part series. Part one was, the A to Z guide for funding your acquisition in December. This is where Mike kind of walked us through what is the criteria, right? What makes an SBA loan differentiated from other loan products out there? What are some of the tips and tricks and little known facts and things that trip folks up along the way? This one is all about if you're serious about getting into this game, there's a lot of information that you can do on the front end to really streamline your process throughout. And that's kind of what we're here with Kayla to talk about today. I'll break down in a second kind of the structure of what we'll be talking about. But then our next conversation, which will happen later this month, is going to be around demystifying acquisition valuation and underwriting. So the idea is that we're kind of at the highest level, really breaking down the core tenets of what it means to be serious about acquiring a company and partnering with a bank like Live Oak, the biggest SBA lender in the game. In 2023, it's 2025 now, so we'll see if that title still exists in 2024. But I'm confident that's probably the case. So these are the right folks to kind of be having this conversation with. And I also want to highlight that we will be, deepening our partnership through office hours and ways to invite them to our forum, so we can have kind of individualized question and support for folks in our network as you look to, to pursue this path of entrepreneurship through acquisition. Okay, so from a structure perspective, I'm just going to kind of go through some of the things that we're going to touch on today with Kaylin. The first one is probably the most important, which is how to present your loan request in a professional manner. Then we'll get into some of the questions lenders ask as you present your loan request and how to prepare. We'll be talking a little bit around questions you should be asking your potential lenders, some of the paperwork that will be involved in the process and what that looks like and why it matters, how the banks are thinking about risk, what the debt service coverage ratio means for you, and then differences between some of the small and large loan processes and kind of what those look like. And then also we'll finish up with some common mistakes to avoid. So, Kayla, you ready to hop in here?
let's get after it.
All right, let's do it. So let's start off with again, you've been in, Live Oak Bank's kind of infrastructure for 5 years. So you've seen a lot. And so the first thing I guess we want to kind of talk about is what is the lender view? Like, what are the things that, a lot of people talk about wanting to acquire a company? It sounds really good. It sounds, like a very interesting endeavor to take on, but there's a big difference between the perception of the person going after the company and what the lender looks at, a sound investment opportunity. So let's just kind of start with from a lender's perspective. what are the things that matter? What are the things that you're looking for with someone who's looking to, acquire a business and partner with Live Oak?
Yeah, that's a great question. I think a lot of people, when their first experience with small business banking, small business lending, is that of an acquisition. It is mostly focused in on the business primarily, which is true, and that can be a really important aspect to the loan and what the lender is focused in on, and so on and so forth. But I also think there's a second part of that, and Mike talked about in the previous conversation presentation, the three things that we're looking at, obviously, right? Like the individual, the business, and the fit. And so, what does that look like from the perspective of what the lenders are looking at when you bring an application or business opportunity to the bank? Um, that looks like looking at your experience, what you bring to the table, your credit history, personally, there's a fit between what's going on uh, with your personal liabilities, so on and so forth, right? Your plan to manage the business, the timeline in which you want to step into it can be important, right? So there's so many different lenses that we have to look at from a lender's perspective that help us get comfortable with a credit or comfortable with a deal. And so understanding that and getting into the weeds of that sooner rather than later is always more ideal and sets you up for more success down the road.
Got it. So let's start with like the first kind of leg of the tripod, which is the individual. So I think a lot of people can relate to the process of like a credit card and what your credit score needs to be and what type of interest rate is associated with, someone's credit score at a certain level. Can you maybe use that metaphor to help people understand what is good, what is great, what is poor credit look like from the perspective of a bank? Debt maybe as well. So when we think about, just the individual's debt ratio, like what are some of these things that you're looking at? What does, what should someone aspire to come to the table with, from that perspective of being a, kind of a credit assessment standpoint?
Yeah. So I want to set the foundation of the way that Live Oak Bank is set up as an operation first to set the stage. We're a vertical lending and industry lending bank, so we've ultimately came up with a theory of verticality where we have a team set up that's in house. Think of a loan officer, an underwriter, a closer, and a credit officer who may focus on a specific industry, and that helps us to scale in a sense because we become more knowledgeable in that industry. We become more efficient because we've gotten reps and have a better understanding of what's a good deal, what are good trends, so on and so forth in that particular industry. So I bring that up because we've got 30 plus industry lending teams where we focus on that particular approach. And by doing that, we've refined credit boxes while we're going through that process. So what you may see on our inclusive lending efforts and our general M&A efforts may look a little different than if we're dealing with a veterinarian who is a historical industry that we've actually built the foundation of the bank on. So for I'll just speak to our specific team in particular. We like to see from an individual standpoint a credit score is around 650 and above, right? Um, that's ultimately where we start our foundation, and then if there's certain folks that fall a little below, or there's some adequate reasoning, history, so on and so forth. Um, we like to paint the story, right? Like we want to tell you what we can and can't do. So starting with the individual's credit score is important for those particular aspects, but it's going to vary based on what industry they're looking to acquire in.
That's really helpful. And I know one of the things that I really appreciate about Live Oak and our partnership as well, Mike and Lillian were really emphasizing in our first conversation that having those introductory conversations with Live Oak is really important on both sides. One, so that there can be, realistic expectations set around what's required, right? Things like this credit score conversation. You mentioned we got 30 teams. We all look at the different types of businesses that factors into what we may be looking for, from you, individually around. And like, that's something that comes with an earlier stage conversation as well. So you can kind of get the specific advice that's most applicable to what your approach is. So I think that's super helpful. And again, we're very, happy to make introductions to the Live Oak team for folks in the audience to initiate those conversations. We'll get to the business piece later. I know it's going to be obviously a big part of what we're going to evaluate. Is there anything
Mhm.
that you would share outside of the business standalone metrics that people outside of their credit score should be thinking about, from a lender's perspective and what you're looking at?
Yeah, I would say the less you have going on the personal side, the better. And what I mean by that is the noise. It becomes a lot more. It becomes difficult when you're looking for a business to manage if you can't manage your own personal finances, your own personal um, situations, goals, so on and so forth, right? Because I think of like if you're someone who's an empty nester maybe, and you're looking to relocate to a certain area that you've longed to live, and you're going to sell a house and move down there, and you're relocating. That's a lot of noise if you haven't done that all before you start the business search process. So maybe you think, maybe you can consider, let me go ahead and start that process, get into the area, get familiar with the area where I'm relocating to, get a better understanding of what makes sense in this particular area and this region that maybe didn't make sense where I just moved from. Right. I think of somebody moving from New York to North Carolina or North Carolina to Florida. Right. So it's just understanding what that particular region needs, and it may be beneficial to make that move sooner rather than later. That's just an example, but I think of examples of folks that maybe have a lot going on from a rental standpoint, like they have a ton of rentals that they're managing, and um, so on and so forth. The story there is going to be really important, and having those conversations, like you mentioned, Brandon, are going to be important sooner rather than later, just so you can come up with a plan with the loan officer. I think it's people underestimate, excuse me, the benefit to utilizing the loan officer, someone like myself, as a resource, right? So having those conversations sooner rather than later, being candid of here's the situation, here's where I'm at. Can we talk through how this is going to impact me getting the perfect business, or getting, down the road, how this is going to impact my personal situation, is going to impact my ability to step in as an operator. I think that goes highly unutilized, and that's what I want to make myself available for, is to those folks who have questions about their personal situations that can make them more impactful when they get to the business purchase situation.
I love that because I mean that's real. A lot of the folks in our network are entrepreneurial in nature, so
Mhm.
that persona of I already have a portfolio of real estate properties, right? Like these are things that you're looking at. Because I guess if I had to kind of boil it down to what you're thinking about, it's like stability. You want to make
Mhm.
sure folks are stable. That means not having your hand in too many pots, not having too much going on. You're
Yep.
juggling financially. I know Mike. He introduced kind of like just a general rule of thumb as far as like debt percentage, basically how much debt you're carrying month over month. As for your to like kind of maintain your personal lifestyle. So that's everything from well, not just debt, but your expenses. So, it's your housing expenses, maybe if you have student loans, et cetera, et cetera. Are you saying that let's say someone falls under the threshold that you feel is comfortable? Are there still some of those conversations that happen as an additional check on top of that? Whether it's okay, you have, let's say, 5 rental properties, they're all cash flowing. They're actually giving you some, let's call it buffer against whatever other income sources you may have. But just the fact that that exists, that creates more complexity. That's going to be something that we want to dive more into. Is less about a number of what do you have coming in and what's going out every month from an expense perspective. Is that fair to say?
Yeah, I think maybe what you're referring to, I think Mike might have mentioned the 50% debt to income ratio that, as underwriters, they will look into to better understand um, how much debt you have personally out there, making sure you can cover your needs, your essential needs, with any income that you're drawing from the business, and that it doesn't add unwarranted stress on cash flow for the business. So uh, that that particular number is something that we do focus in on. It's going to be the primary focus from an underwriting standpoint, and when we're looking at the individual. Uh, but I think it's just, as far as what I was referencing, I think it's mostly just having a tight grip around what your personal financial situation looks like. So if you've got 5 rental properties and you know they're all cash flowing, and you have you have an understanding of where you stand financially. Those are more That's a more ideal situation than someone who has, like you mentioned before, referred to before, has their hand in so many different pots that they don't understand where their money or their finances are going to personally, which then gives our team and our underwriters less confidence in their ability to manage business finances, if that makes sense. So
Yeah, yeah, it does. Okay, excellent. So just for the audience, there's a set of slides that we'll share with the audience, and there's some resources in these slides. For example, the 10 things a lender wants to know about you. We'll make sure we send that over to you so you can get that list. And also the top 10 questions to ask a lender. So let's put the hat on the other head here, Kalen, and kind of talk about, what are some of the questions that someone who is starting off should be thinking about asking their lender? And as you're looking at, kind of what is important to you, what should be on the list of questions for folks, talking to a bank?
yeah, yeah, I can't echo that more. That if you do get the materials, or when you get the materials, please go back and look at those questions, because I think it's worth having in your toolkit when you approach having conversations with the bank. But I think from the standpoint, if you are new, there might be some questions that are on the top of your mind, like, what if I don't have collateral? Because I think most folks think of the business banking process as similarly to maybe buying real estate, right? Where we're strictly based, they're lending on LTV requirements, and there's certain requirement metrics that have to be met from an LTV standpoint in order for the deal to close. Um, with the SBA loan program, we have the benefit to finance businesses and goodwill that aren't relying on collateral, that we wouldn't be able to do if we were doing conventionally. So if you have that question in mind, I think the simple answer is, um, collateral is not going to matter for your loan if you're doing an SBA loan, because it allows us to finance at a higher LTV requirement than what you would see with a traditional commercial lender.
Got
So,
it. Any other that's major, obviously, because I think
mhm.
I'm not sure how much of a differentiator that is between Live Oak and some of the other players out there, but I think that's clearly a big advantage for a potential acquirer, not having to worry about collateral outside of the business. What are some of the other what you would consider big differentiating questions when you're evaluating a lender?
Yeah, I think understanding the benefits of the SBA program if you're looking at buying a business is important. So if you're asking, like, what loan products are available to me, there's obviously the conventional side, which gives you access to oftentimes shorter terms, maybe a little bit more competitive when it comes to a rate. But what you'll find being, the being a downside to that product is the shorter term, having loan covenants involved, having some prepayment penalties involved. So there's some things that make it a little bit tougher to get approval with the conventional loan, especially if it's goodwill and there's no collateral. There's not a lot of collateral involved with the loan. With the SBA program, the main benefit there, like I've mentioned before, is the longer term, the non prepayment penalties, the ability to finance more than what you would traditionally get from a conventional lender, and flexibility on the equity injection. So, understanding what products you're looking for is going to be important, and those are definitely questions we get fairly often, because if you're new in the space and you're trying to understand what's available to you, why wouldn't you ask that question, right? Like, you want to understand what your options are for financing. So that's a pretty big question, along with what does the process look like? Um, the process for an SBA loan is going to look different than the conventional loan process, because there may be some requirements that you have to follow with the SBA program, which is, again, as a bank, we have to follow the SBA's SOP, which is 600 pages, right? So it's a lot of words, a lot of information to draw upon. Um, that's where the expertise from Live Oak comes in, because we can speak to what's eligible, what's not. Um, but we also can give you set you appropriate expectations on what the process will look like based on your particular scenario. If you have real estate, obviously it's going to take a little bit longer in your deal. So understanding what the process will look like is going to be pivotal, because when you're going to set expectations with the seller and whoever you're buying the business from, they're going to want to understand when they're getting paid, right? So you, understanding and having confidence and competency in the process is an important question. So
Great. Um, and so we're going to get into the nitty gritty in a second around some of the documents that folks need to prep. I want to ask you like just a general question. This is just your gauge of it. And it has to do with timeline as well. But if you had to say like out of 100%, what percent would you say is the pre-work that you can do with the bank? So looking at your own credit situation, look at, kind of the industry you're focused on, et cetera. And then the amount of work that goes into once you found a target, evaluating a target in context of the bank loan. How would you split up those percentages? In other words, it's like, how much of the process can you kind of, get done by really locking in early and being proactive versus the things that are just going to be a part of the craziness of getting a deal over the finish line?
yeah, I would say if you don't prepare, it's tough to give percentages, but I'd say if you don't prepare going into it, asking the questions that I just laid out, oftentimes the process and the work that you do on the back end becomes longer, because you're at the same time trying to figure out, balance your own personal situations. Like if you're trying to lower some accounts that lower some credit card balances because you don't want that to affect your DTI, but you have the money to put down. So you're trying to figure that out, balance that while you're also trying to fill out our loan application. That takes a little bit longer, and you're more likely to make some simple mistakes, right? Um, so I think the more time you spend in preparation, so ideally you're spending a lot of time in preparation, understanding what you're looking for, understanding your personal situation. So maybe that's, let's just say it's 30 to 40%, right? That then makes the process when you get to the loan to, the loan application process, 50 to 60% of your time is spent just flushing everything out and putting things on paper, right? And that just makes it even more fluid because we understand where you're coming from and what you're looking at, um, and it just makes everything flows better. So hopefully that makes sense.
Yeah, no, it does. And so that's a good segue into kind of like the timeline conversation, which is obviously very much related to the documents conversation. But can you give us maybe just a general sense of what the expectation should be process wise for a timeline? And I know it varies depending on deals. Maybe there's, phases of the timeline. But to the extent that you can kind of match a period of time to a set of activities, what would you share?
Yeah, we usually give a timeline for a transaction, like a goodwill acquisition of, from start to finish, anywhere between 75 to 90 days. It can be sooner than that. I think where we ultimately get, this goes back to the preparation question, where we get hung up in that process is if we send you a list of documents needed, it takes a long time for certain things to come in. And that goes back to the preparation and the personal side. If I'm asking for a personal tax return from you, but you haven't even filed that. You don't even know what that is. Right? Hopefully you know what it is, right? But having those documents and things prepared and organized makes it go that much faster. So we like to say that with Live Oak, our coin term is speed is our weapon. We will match the pace that you bring to us. And so that timeline is flexible and can be shortened based on the organization of the customer we're working with, and the third party partners that they end up partnering with as well.
I love that. Speed is our weapon. That's, it's music to the ears of folks that are, have done their homework and they're ready to kind of move forward. So I think that's a great kind of, motto. And basically to kind of recap, if someone is under LOI, let's use as a starting point, letter of, intent to essentially sell the business with a seller, 75 to 90 days is generally what you think is a reasonable amount of time to kind of do all the process steps. And that could flex obviously based on individual circumstances, but that's how you're thinking about it generally. Okay, excellent. So, the name of this conversation is essential documents and timelines explained. So let's get to the essential documents, the meat of this all. Document prep. Can you walk us through from the lens of a banker, what are the documents that are important to this process, why they're important, and maybe even a little bit of color around of all these documents, which ones are really kind of, what you consider to be central to the decision making process from your end?
Yeah. Um, so I'd say to start, just to go back to the presentation that Mike had done and set the stage for the three components to a good deal, right? The individual, the business, and the fit. Um, that's ultimately what we're looking at from the standpoint from the documentation side. So we'll ask for documents from the individual, that being personal tax returns. We'll ask for W-2s, and then we have our own internal like application documents that we have to get, that are more so just the generic applications that you would typically see with any loan process, right? So those are usually the documents that are going to be most important up front. Along with that, it's a personal financial statement where we're understanding our borrowers' um, liabilities, what they have to their name, um, so on and so forth, right? So that's an important part of the loan process and understanding where a borrower is personally. um, on the business side, we're looking at the business, the subject business that we're looking at. We're looking at their business tax returns, their year to date financials. I know it's going to be kind of an awkward period now because we're in a new year. So those year to date financials, you may be waiting for updated documents through the end of the year if you've got a deal under LOI. So just understanding what the year to date financials look like usually is very telling of where the business is headed. So understanding that a little bit better. Balance sheets are going to be important to understand the liabilities of the business, what they carried, how much cash they had that they were leveraging to keep operations going and keep everything afloat. Um, and that's for the most part the essential documents for the personal and the business. There's deal related documents, those LOIs that you mentioned, that are going to be important to understand what the deal structure looks like, so we can determine what cash flow looks like. Because cash flow is a big point of emphasis in understanding, if the business can support the debt it's taken out. So by utilizing all of those essential documents, we're creating a story, we're creating a memo of what does the financial situation look like for both the personal and the business, that helps us get comfortable with this loan opportunity.
Got it. And so, kind of thinking about it from the perspective of there's your personal finance perspective, then there's your business finance perspective. We'll go a little bit deeper into how you assess the risk, how you assess
Mhm.
the stability, the debt service coverage ratio, et cetera, in more detail. But let's just kind of start with the level of sophistication that you would like to see from a potential acquirer when it comes to reviewing the P&L, the balance sheet, right? The financial statements of the business. And keeping in mind that many of these businesses, right, sub 5 million loan size, that's where SBA, that's where you cap off with the
Mhm.
loans that you're
Mhm.
issuing. You're going to be looking at some mom and pop type businesses that may not be as sophisticated when it comes to the documentation. From your perspective, when you run into a situation where maybe that sophistication isn't there as far as the current state of the business finances, how do you partner with the acquisition entrepreneur to work through that and see if you can still get a deal done?
Yeah, that's a great question. I think that's something that Live Oak does really well, that you may not get at every other lender out there. But we really take the approach of, here's what we can do, right? Based on what we're seeing and based on how the business has been operated to date. Um, don't get me wrong, we'll do everything possible to understand the financial situation, how the business was ran. We usually ask questions based on our review of those documents once they're submitted. We're notating questions that are heavily detailed, right? Like we're looking at cash add backs to cash flow. We're looking at one-time expenses that maybe the seller, had that won't be moving forward. We're looking at what the seller's salary is and what the buyer's salary is, just to make sure, the seller just got to the end of their career and decided they wanted to take 400,000, but the buyer's like, well, I don't really need that much. We want to understand that. So we will do everything we can to understand what cash flow looks like. And if it's just not, if we're not feeling confident in what the seller's got, and um, that we've gotten to a situation or a standpoint where we have a final number, but it's not matching what the purchase price is, or so on and so forth. We have the conversation of, here's what we need to do to make this work, and here's where Live Oak can help. Right, this is what we can do. Otherwise, these are the other things that need to happen in order to make the deal work.
Got it. And there's a few folks in our network um, who come to mind. And it's funny, they've partnered with Live Oak Bank, and they're like, they use this term that's a colonoscopy going through this process. And on one hand, it obviously sounds painful, but on the other hand, it's like, wow, through the process of partnering, maybe some things were highlighted, discovered, leaned into that would have been missed or not necessarily paid attention to that ultimately was in the best interest of the acquirer. From your
Yeah.
perspective, how often do you see kind of that dynamic, right? Where maybe they haven't brought in an official kind of diligence company, to kind of go in and do quality of earnings, et cetera. And you all are ultimately kind of filling that gap informally. Is that something that you see a lot? Is that something that you advise
Mhm.
folks to not put themselves in that situation? Like, what's your general kind of take on that?
Yeah, I think that's going back to what I was saying earlier. Like, it's here's what we can do based on what we're seeing, right? Because we don't want to overstep uh, our influence in the transaction, right? Like, we don't want to be that quality of earnings company, because we know we aren't, right? Like, we rely on those folks that are out there who can dig more into the weeds and request and do all the the due diligence work. But I think we, based on the amount of deals we see and the amount of opportunities and balance sheets and profit and loss statements and tax returns that we look at, we have a lot of expertise that and value that we can add just based off of what we're seeing on the surface. Then we can turn around and say, here are the questions you need to ask to the seller, and be straight with them. I normally encourage folks to get on Zoom calls and get in front of them to ask these questions based on the review that I have, and the bank has with their loan, because we're invested in that loan just as much as the entrepreneur at this point, right? So, like, we want to be successful together. And so the questions and the value that we add, that's primarily what we're getting at, is helping the entrepreneur to be armed with information and questions that they can then take to the seller, that gets them more to understanding how the business was operated, understanding if this is a good fit, and identifying key risks that maybe the seller wasn't even aware of when they listed the business, right? So those that's what we are here for, and we've got a lot of refs with doing that. So I think we add a lot of value that way.
Got it. Okay, thank you. I appreciate that. All right. So, on the documentation side, things that the bank is looking for: personal and business tax returns, P&L statements, balance sheets, the debt schedule, and then the personal business information forms that come with kind of the acquisition of the company. So, at the bottom of this all is assessing risk. So, can you
Mhm.
tell us a little bit more around what risk are we talking about? How are you assessing those risks specifically, and how these documents help you do that in more detail?
Yeah. Um, I think the way I some generally summarize risks to be um, financial stability, right, of the business, the steady income and cash flow into the business, um, responsible debt when it comes to what we're lending to the customer. Just because the business can handle X amount, right, of cash flow doesn't necessarily mean that, with this 10-year loan, that, we could get comfortable with this amount of debt. Maybe we need more of an injection or more of a seller note to get more comfortable based on where the business is at. So assessing risk in that front, I like to tell folks too, like, we look at two things, or I look at two things when I'm reviewing bid credits, and that's who's the operator of our business, what are they bringing to the table, knowledge. We talked about that a little bit, but on the business front, when we're assessing risk, we're talking about any disruptions to cash flow that we can identify on the forefront, right? So that might be customer concentration risk. It might be economic shifts. We see a lot of companies in Florida that experience construction companies that are experiencing, a lot of growth based on migration. And so, can we assess that, better understand that, um, better put key risk mitigants in it, maybe it's creative seller notes, so on and so forth. So that's the way we were assessing risk. And we want to try to jump in front of the disruptions to cash flow as soon as possible. And that, at the forefront to make sure, there's no disruptions and there's nothing that puts pressure on the customer post close.
Got it. um, One of the things that kind of comes up, risk is basically assessing, ultimately stability. And so this idea of kind of the business plan comes into the conversation. And, there's a lot of definitions of what a business plan can look like, right? There's the MBAs, right, where they're coming up with a super sophisticated, SWOTs and all kind of stuff. What, from your perspective, is a clear, realistic business plan? What should folks be thinking about, when delivering that, and how important is that to the evaluation process?
Yeah. Man, I think just clear, realistic business plans look like a understandable and realistic transition plan, right? How are you going to set yourself up for success in the first 30 to 60 to 90 days? And really sit with that, right? Understand where the business is at currently. I like to tell folks that if you're trying to jump into the business and make a ton of changes in the beginning, just so you can experience and success later on, that's not the right strategy, right? Like you want to get in the door and understand what the business is and where it's currently at. Make sure you have a tight rein on where the business is going and how it's currently remaining stable, like we talked about earlier. And then from there, you can start to slowly incorporate those changes that you're looking for to make the business more profitable, more efficient, more lean, so on and so forth. But setting that up and really setting yourself up with the understanding of a clear transition plan in the business plan is going to be really important and something that we rely on a lot, especially if you're looking at a business and you are leaving corporate and then transitioning over to the business plan, over to business ownership, understanding what that looks like, right? So that's going to be important. Projections are important just to better understand. Here's where I'm headed. Here's where the business is currently at. If you're saying the business is at 6 million, but you can take it to 12 million, that's awesome. But explain to me how you're going to get there, right? So it's a good exercise to do when you're going through an acquisition to understand the number side of things and put some key assumptions in there. Um, and then just focusing on employees, like understanding who are key employees of the business, who you're keeping on board, who's going to hold those key positions, those key roles with the business, um, so on and so forth. Those three things are really crucial to a successful business plan. You got to understand, where the business is headed and how to set the business up for success, and that's a perfect place to outline it.
Yeah, I think Mike said it really well. He said, don't pay for potential, basically.
Yeah.
It's kind of it's kind of what you're getting at here, and it sounds like the other piece of it really is, that first 120 days is really really important, right? So you're kind of
Mhm.
coming in, being very clear about what you're doing, and you're not in the turnaround game. You shouldn't be turnaround plans you're looking at in the first 120 days, is what it sounds like. Okay,
Mhm.
so when we talk about stability, at the core, from a banking perspective, the debt service coverage ratio is obviously a big, big, big factor into this. Can you just walk us through, from your perspective, what the debt service coverage ratio is? What is a healthy debt service coverage ratio? Maybe what are some of the mistakes you see people as they think about DSCR, and they're bringing you opportunities, and you're kind of saying, "Hey, look, here's kind of the 20%. If you focus on this, you'll probably be okay here. Don't worry about anything else. Focus on this aspect." Right? Tell us a little bit more about DSCR.
Yeah. So debt service coverage ratio, I'm sure most, if not everyone, is familiar with that. Measures how much cash flow your business has available to cover loan payments and any other debt payments. So I think where folks start to get tripped up is we're looking at loan payments and any other debt. So can include seller note payments that are going to be paid to the seller. That's included within that debt service framework. So when you're putting together an LOI and you're trying to understand what cash flow is available, just making sure you understand that crucial piece of it. But the way that Labit looks at it, we're looking at net operating income, and that being well, I'll define it afterward. But the equation here being net operating income divided by the total debt payments. And so, really, what we're looking at here for an ideal debt service ratio is 1.5. So all that really means is for every $1.50 in cash flow, um, you can support $1 of debt payments. So you want to have make sure you have that cushion there in case, economic shifts happen, prices raise, so on and so forth. You have a wiggle room there to cover debt obligations at a healthy measure without having to drastically change aspects of the business in order to meet your debt requirements. So, and that can look like if you're looking at net operating income, an example of that would be, you're looking at 120,000 of available cash flow at the end of the day. That means that you can support anything up to 80,000 and annual debt payments. So, you know, adding up all debt payments at the end of the year, 80,000 is where you would cap out at where you would meet the 1.5 debt service.
Yeah, got it. So because the SCR boils down to NOI, what are some of the things you see that catch a lot of people up around what NOI is being reported as and what,
Mhm.
ultimately is the real deal when you kind of look under the hood a little bit?
Yeah, so acquisitions can be tough because there's a lot of moving parts with, like we talked about earlier. There might not be sophisticated. There's sophisticated sellers, and then there's non-sophisticated sellers out there. So you'll meet and engage with a wide variety of them, and you'll see financials from either side. But some folks, they decide to pay for their whole life through their business, right? So they're paying country club dues, they're paying memberships to, for their kids to attend private school, so on and so forth, right? So all being able to dig into the weeds of what true cash flow looks like is important, and that's why Live Oak has that net operating income being net income, which is the bottom line of the business, plus any of the ad backs that we see out there that might not be continuing moving forward to get to true cash flow. So that might be seller discretionary earnings that aren't continuing moving forward, or one-time expenses. Maybe we're removing an employee because they weren't necessary, so we add back their salary. Maybe we're adding an employee because it's necessary because the buyer doesn't feel like they can wear two hats when they come into the ownership of the business. So that net operating income is going to number is going to look different based on your deal and the story behind it. And so the changes there and where people get tripped up is just not understanding the full story, right? Because I think a common one is one I just mentioned. If you are someone who is going in to buy a plumbing business, and you've got a, a sibling out there that has the plumbing license that's going to come on board and help you out while you manage the operations. Maybe before that, the business was managed solely by the master plumber, right? Who was running operations and was doing the plumbing work. So that basically you're now expensing two individuals post close through the business, your sibling and yourself. So understanding that means less cash flow available to the business post close is where folks get tripped up. And so that's what we're look at, and we'll help people understand and diagnose and start to get to the bottom of what available net NOI is there to the business in order to cover whatever debts we're trying to get out there at a 1.5 debt service.
Got it. And again, this kind of underscores the importance of like really partnering with the bank, right? Because you can have these conversations around a business plan and how that translates into a pro forma and ultimately the decisions you're making and whether this is the right business or not. So I think that's really helpful insight. Okay, so different levels of documentation are required based on different types of loans, and that can be based on loan size and how you all are kind of running processing time associated with those loans. For Live Oak specifically, can you maybe just give us a sense of how that plays out, what types of loans and what type of processes are associated with those loans?
Yeah. With the SBA program, which is what we utilize most with these types of transactions, the SBA has modified their SOP. They tend to do that fairly regularly, but um, one recent change that has been modified is the addition of looser underwriting and closing requirements for loans that are under 500,000. So if you've got an acquisition that you're looking at that's under the $500,000 loan range, and now that's not necessarily the purchase price, but loan final loan amount that you're requesting from Live Oak is where that matters, because some folks, where they get tripped up is if you've got a $500,000 purchase price, there's additional closing costs and on top of that, working capital needs, so on and so forth, that might increase your loan balance above the 500,000. And at that point, that would go through our standard SBA underwriting process that gets you closer to the 75 and 90 day closing window. And then on the express route, which is the loan process under 500,000, that's where we would start to give a timeline that's more in line with right around 30 days for closing, faster processing, less documents, um, so on and so forth. And that program is really great for acquisitions are good, and that particular program, but those are that opportunity makes it more advantageous for business owners who are also looking for working capital a lot quicker and or expanding. So you're a current business owner trying to buy that salon next door, whatever that might be. But you need some, to close on that quick, and it's, you know, not that much. And it's within that dollar range, then you can, utilize that program. So
Got it. Helpful. Let's get into, I guess, what I think this is really all about, which is what mistakes to avoid when it comes to documentation. That's everything from organizing to identifying what's complete versus incomplete. Some of the inputs that, kind of matter the most that you see people flubbing on, and should know proactively going into it. This is a focus area. Just help us kind of understand what are some of the trip ups that people, generally, that you see as people go through this kind of documentation process.
yeah, this goes back to what we started the conversation off with. So I love how we're going full circle. But incomplete or inaccurate financials on your personal side. So not understanding so when we send out a personal financial statement, we're trying to understand your personal liabilities and what you currently have outstanding, so on and so forth. If you don't have a tight grasp on what that looks like for you personally, then it just makes it a lot harder during the underwriting process if we have a lot more questions like, how long have you owned this property or how much equity do you truly have in it, so on and so forth, right? Or did you realize you had that extra credit card out there that is delinquent, right? Like all reasonable things that can happen for folks who have busy lives, but not having a tight grasp on that can be a common pitfall that folks run into that gets brought up later down the road that can prolong the process. Um, I think commingling personal and business funds, like if you're a current business owner looking to acquire another business, and your business is small enough that you've got a lot of your personal resources flowing in and business resources flowing out to you personally, that can usually become a red flag because we don't understand cash flow. We don't understand what's going on there, what's truly business related, what's truly personal. When it's commingled, it's just it makes everything cloudy and can make calculating that debt service that more complex and complicated. And so, whatever you can do to keep your personal and business separated, if you are a current business owner, the better. Um, and then over or underestimating loan needs. That goes back to just knowing and partnering with a lender sooner rather than later. We don't, have an expectation that you come to us when you have a loan available. If you just want to understand the loan process, you just want to understand what it takes to get in the door and what your conversation should be looking like with a seller or a broker. We want to have those conversations as early as possible, right? Set the expectations so that you are aware of what is needed, so that you don't underestimate what the loan process looks like to the seller, and then later down the loan, you're backtracking that it is going to be 75 to 90 days, not 30 days, like a home mortgage. So understanding that is going to be important to set expectations and build rapport. Um, Overcomplicating loan structures can be an important point too, or important common mistake that's made. Um, that is goes back to when we're assessing risk. There might be some key risk out there, like customer concentration, that folks are fully aware of. And so what they'll do is they'll try to overcomplicate it with maybe doing like an earnout structure on a seller note that has a forgivable function if this amount is met or this margin is met. And it gets really overcomplicated when those types of structures get thrown out there. So that just goes back to partnering with the lenders sooner rather than later, understanding what the lenders have seen. We have definitely seen a lot of businesses out there that have some level of concentration risk, and we've gotten comfortable with it based on certain structures, right? So have those conversations sooner rather than later to better understand what options are available to you and what's bankable rather than trying to come up with that on your own. And it's just from experience because we've seen that a lot, and it can be really helpful and help expedite your process and build credibility with a seller and a broker.
So I'm gonna ask you a couple of follow-up questions on this because I think these are there's a lot in these, and I think we could probably spend 30 minutes on each one of these, but I think two kind of stand out. So let's talk commingling, right? And I think that speaks to one, how forward-thinking people are. I think some of it is how sophisticated people are, and they may underestimate how important that is from a bank's perspective to have that separation so you can understand what's going on. If that has not existed, and then you're now having these conversations, is it a done deal at this point? Like it's already happened. You've already seen it commingling. It's like, hey, look, this is not gonna work for us. I'm sorry. Or similar to like incomplete financials, where it's like, hey, they can come back in and give you what you need, right? Or they can kind of modify things to get you to where you need to go. Is the same true with commingling, or is it, hey, we've seen things that make us uncomfortable, so we're gonna kind of step away because we've seen enough? Or is there a way to kind of get back to that place that you need to be?
Yeah, I think it depends on the scenario. Everybody's situation looks a little bit different. If you're someone who, I think of a landscaping business where you run every expense for your personal, someone hasn't taken a salary, but they run every expense for their personal through the business. Well, then it's harder to understand what expenses are truly um, essential to the business or essential to what you're doing, or how you're living or so on and so forth, or what you feel like is ideal to you and your lifestyle. So that's where it starts to get a little complicated, or it starts to get a little confusing, and to the point where a lender might just think, in particular Live Oak, there's just a lot of noise here, and it's harder for us to get comfortable with the true cash flow because it's showing negative, but it's because you ran all of your expenses through it, and we don't understand what's essential and what isn't. Um, so I think it just depends on the scenario. There are certainly there are certainly opportunities to come back to reality and reconcile that. I certainly want people to do that sooner rather than later. But I think overall, if you're actively doing that while pursuing a business loan, it can then lead to complications.
Yeah, got it. And then the second kind of follow up is really around the financial engineering, the complicated deal structures, which I see a lot of folks in our network. Many of them are, ex PE guys, ex banker guys. They kind of get off on, kind of being the Reginald Lewis's, in their mind of kind of executing these transactions. And, you know, they would make the argument, look, I'm doing this to kind of de-risk the transaction. I'm doing things that are going to ultimately get me a better outcome and you a better outcome. How should folks kind of reconcile that tension between an arrangement they actually believe is going to help protect their downside or whatever it might be, and the simplicity that you value as a partner on the banking side to kind of just understand and everyone be clear on what's happening? I mean, is there some level of kind of, is there some middle ground? Is there a threshold? How do what's too much or what's not necessarily worth from your perspective, the benefit?
Yeah, there's a couple things there because I think the what ends up happening when you overcomplicate deals is sellers get confused, right? You get somebody who's not sophisticated, and then you get an ex PE guy who's throwing a structure at them that they don't understand. As a seller and as a broker, you might you might be less inclined to accept that offer. So I think that's the first area issue that kind of becomes a red flag when you're submitting an LOI that's a little too complex, and broker seller don't understand it. They can't understand if they're losing money or gaining money, whatever it might be. So they might just choose to not accept it, right? So that's the one thing that just we want to make sure it doesn't happen to you and that you get an opportunity to compete for that business. Um, the second thing is, I think from a loan standpoint, for if you're going after the SBA loan, there's eligibility requirements, right? That keep us in check to make sure that the SBA loan is the bank can actually do that based on the structure that is currently happening. And there's quite a few rules around the M&A, like M&A type deals, acquisition deals that the SBA covers in its SOP. And oftentimes what ends up happening is there's a clash between what's eligible and what is being, what we're trying to do to de-risk the deal. And so my suggestion based on those two things is partner with the lender sooner rather than later so that we can creatively tell you what is eligible under the SBA program and what we can come up with together that ultimately tries to get to the same solution. So an example of that might be, like I said, an earnout, where an earnout might be, we lessen the purchase price, but we give the seller an opportunity to earn back more based on the performance of the business. Well, in reality, that's something that's not eligible under the SBA because the purchase price isn't defined. The seller has an opportunity to get more down the road. So there's not a defined purchase price. So what that does is it alters the valuation of the business. When we go to do a third party valuation, it alters the required equity injection amount that the SBA requires for all of its 7A loans that are funding goodwill. So it can become more complicated, which is the reason why the SBA SOP says earnouts are prohibited. Doesn't mean necessarily we can't come up with a creative structure with a seller note or something else to help get us to that point and get us to de-risk the deal. It just means partnering with the SBA lender sooner rather than later. So that's what I recommend there.
Got it. No, that's a really good insight there. Kind of this idea. You think about kind of the financial engineering. It's always the earnout. The earnout is always the the
Yeah.
the lever, right? So if that's oil and water with the SBA, generally speaking, and you can kind of get around in some cases, but kind of coming in understanding what is going to be a more seamless process. I think that's a really important piece of information for folks in our network to understand. All right, I know we're getting close on time. A lot in here, but let's end off on the pro tips. So, haven't been in a game, haven't seen a lot of these. If people want to get ahead of the game and kind of come in, really understanding what those pitfalls are and getting ahead of those, what are some of the pro tips that you would recommend for folks?
Yeah. First impressions matter, right? So if you're interacting with me and like I said, you take the instruction to get into those office hours like Brandon mentioned, or make an introduction just to understand and ask personal questions and set expectations and set yourself up for success down the road. That really goes a long way with building confidence with the bank partner and a lending partner to vouch for you down the road when it comes to credit decisioning. Um, Having solid answers to some of those critical questions, like I go back to my plumbing example, who is going to run the business? Have you thought about, how you're going to bring on another employee when the seller hasn't historically done that from a cash flow perspective? Having those solid answers for that is going to be important. A lot of times buyers fall into the whole of, not having those questions and figuring it out as they go. And that's usually not a great sign. And finding the best partner and best operator for that business doesn't necessarily mean that you're going to have it all put together when you come bring your loan package to me. But I think thinking through those things and being prepared shows a great deal of confidence. That goes into prep and organizational documents. We talked about that a lot today. Making sure your organizational documents are prepared, tax returns, personally at the bare minimum need to be kind of, out there, easily accessible. Understanding what it takes to calculate the SCR, debt service coverage ratio. Again, I'm happy to have follow-up conversations along the lines of that, because I know it's something that can be, a little complex, and you'll have follow up situations that you want to better understand. So I'm happy to answer those or set time aside for that. But then lastly, I'd say be mindful of your timelines. Nothing's worse than you have an expectation, the seller having an expectation, the bank having an expectation, and trying to get everybody in together to on one accord. So if you're mindful of your timelines, that will help you in the long run to help set expectations and keep everyone moving at the same pace.
Excellent. Right on time. So, first off, this was an action-packed session. So I want to thank you, Kalen. Thank you, Lillian, and Mike, obviously, who's a little bit under weather now, for bringing what I believe is to be the core foundational pieces to understand if you want to get serious about acquiring a business. Again, this is number two of a three-part series. We already had kind of the A to Z funding or acquisition conversation with Mike and Lillian. This is around the documentation process and timelines with Kalen. Our next one will be later this month around demystifying acquisition valuation and underwriting. So as I mentioned before, we're going to connect in terms of office hour sessions and one-on-one intros with the Live Oak team. But I just want to say thank you on behalf of the network. We're looking forward to continued partnership and getting more folks into this space. So with that, we will adjourn the session. Thank you again, Kaylin. Thank you again, Lillian, who's in the background here. We really appreciate it, and we will be back very soon with part three. Take care, everyone.